India right now. What phase are we currently in?
This is the opportunity phase. This is typically the time when people will search for reasons not to add to their investing journey in equities, and history will prove that it's exactly the opposite. I think the ability to generate alpha in the large cap space is getting tougher and tougher. And say 5 years from now, do I have as much confidence in outperforming the benchmark on large cap as I have on small, mid, multi cap? My answer would be I probably have half the confidence. I'm just being very honest.
It's a very bold statement. I like that.
People say that, asset allocation theory also means that as you get older, you should dial down the risk and you should look at fixed income. I think you have to put in context how.
What are the parameters that I need to look at when I pick a mutual fund?
The way I like to filter, I will pick 2 of the largest fund houses. I will pick 2 from the middle pack. And I'll pick 2 of the smaller, younger people. So I have a mix. If you had to ask me, tell me then one fund that I should buy because I'm only going to invest in one fund, I would.
Mr. Anthony Heredia, welcome to the show.
Thank you, Sharan.
Mr. Anthony, you're the 5th CEO that I'm interviewing, who is the CEO of an AMC.
Okay.
And you're a special one because you became a CEO at the age of 35. You've been investing for almost 30 years now.
Yes.
Right? You've seen almost all kinds of market cycles.
Correct.
The current situation that we are in India right now, what phase is this called for people who are just investing right now? What phase are we currently in?
I think the phase, I can use adjectives, right? This is the phase that demands courage and bravery. Because common sense will tell you that these are phases, especially after you're coming off a theoretically 18-month period of 0 to small positive or small negative returns, depending on which date you pick. History, common sense will tell you that these are times you should be investing money in equity if you have a long-term perspective. And I put long-term as long as you have a 5-year perspective, right? So to my mind, this is the opportunity phase. To look beyond the noise and actually commit to investing. It's easier said than done because this is typically the time when people will search for reasons or be given reasons not to add to their investing journey in equities. And history will prove that it's exactly the opposite. And it's ironic, no? We are talking about this in April 26. To me, the best way or memory or history you should reach out to is what were you doing in March and April 20? Probably at that time you thought the world was going to end.
Right.
And anybody who had like I said, the bravery or the courage to look beyond the noise and the immediate term is a very happy person today. I'm very convinced that if you do the same thing at this moment with a 5-year, 10-year time frame, life should be nice.
Got it. So for somebody who's investing right now,
yeah,
what should be their asset allocation according to you?
So the asset allocation is a slightly different subject, Sharan. Firstly, I think asset allocation has some linkage to who you are and where you are in life and what you want to achieve. So if I put that in perspective and say, listen, if you're a young individual in your early 20s or early 30s, then I believe you have the ability to take risk. I believe a lot of your goals need a lot of wealth to be created. And so for that person to be having 60 to 75% in risk assets, predominantly equity, is par for the course. And if that is the case, this is as good a time as any to be reaching that 60 to 75%. The one place where I kind of differ from a lot of people is people say that, asset allocation theory also means that as you get older, you should dial down the risk and you should look at fixed income. I think you have to put in context how wealthy you are at that point. Because some people then, I have seen a lot of clients I meet, they've reached a point where they can continue to take risks. And so they actually use that opportunity to start building wealth for future generations. Right? So you don't think of yourself in isolation. You start thinking about the family, the next generation. And so given that India is a growth economy, given that we are talking about Viksit Bharat, I would say 50% in equity is a fairly comfortable number for asset allocation for most people. unless there is some circumstance which is different for you, where you clearly need some more predictable incomes, and so therefore fixed income makes more sense. But I would say that must be 10%, 20% of the people. For 80%, anything between 40-50% into equities to 65-75% in equity, I would believe is par for the course.
And the remaining money, where should we put it?
I I think in the last 1.5 year, I think we've been taught that don't necessarily ignore gold. Right now, I have is a separate topic of what is your view on gold right now. I think it is toppish. I think a lot of the great returns from gold as an asset class have happened. But I think one lesson one should have picked up is that if I'm thinking next 10 years, 20 years, having 3-5% in gold is not a bad idea. Or you have, our industry has a multi-asset funds that have an exposure to gold, have a decent chunk of money in multi-asset funds, your gold is solved. The one I think I will introduce to people is, I think people need to be a lot more open to the extent that they are able to international investing. I've worked with a lot of global firms, and if I think about other markets in Asia, right, they're all actually older than India in many ways in the mutual fund industry. What I've found is typically in the first 20-25 years, people tend to invest primarily in their home country. It's like nothing is better than equities and fixed income in the place that I reside. At some point, they start looking outside and saying, oh, actually, there are opportunities outside and they're probably as good, if not better. And they start to diversify. I genuinely believe in India that point is also come. And so, therefore, thinking about having 5-10% in investing in equity outside India is not a bad idea. And also, if I was to argue it from an investment lens, right? One of the things I think has not worked for Indian equity markets in the last 18 months is the big trade has been AI, right? And obviously, the big trade has been AI and the guys who create AI. The people who create AI or the companies that create AI are in the US, they're in China, they're in Taiwan, they're in South Korea, all of that ecosystem of producers.
Right.
I'm not ready to say that AI is a bubble. And so, therefore, for me, it makes tremendous sense to diversify and start picking investments in countries like US equities, China's equities, Japanese equities, maybe 5-10%, just to give myself an opportunity to drive returns from things that are different from what the opportunity is here. So if I was to, I've gone at length on this. So therefore, I'm saying 60-70% Indian equity, maybe 10% in international assets. I would say predominantly equity if you're doing that. Another 5% in gold. And 10%, I would say is, indulge yourself. Some people like art like I do, invest in art. Some
Oh, wow.
people, but you have to love it, right? So then it's half investment, it's half just doing it because it makes you happy. Some people would believe that they have enough capital to continue to buy real estate. I think REITs and InvITs are becoming a lot more. So stuff like that. I mean, I don't think it's prescriptive, but I would say predominantly Indian equity, have 5-10% in international equity, and then the balance in gold or clutch of multi-asset funds.
So, can you talk about how you invest your own personal money? Like, if you can also name the schemes that you've invested in.
So if you think about it, all my mutual fund investments is a clutch of the fund houses that I've worked in the last 30 years.
Okay.
So in the last 4 years, if you ask me, where have you invested? I've invested in Mahindra Manulife because it's convenient. It's home. I have great confidence in anyways what we do. But I don't think fund house selection is that big a deal. I think one of the great things about our industry is that there are so many quality fund houses. So I don't think it's about which fund houses you pick. I think it's about making sure you actually invest what you're supposed to invest. You give it the right amount of time that investment is supposed to get. And the third is, don't get caught up in too much of these, sectoral, thematic. Just stay diversified. Life is okay. So that's personally what I have done. The thing that I'm doing, which is probably out of sync with, in some sense, asset allocation, but let's put it this way, I'm indulging myself, is when I said 5-10% in international equity, I'm probably going closer to 20-25%.
Okay.
Because like I told you, Sharan, one of the outcomes of this drive with my daughter in the morning, listening to podcasts, a lot of them are about international markets. You're listening to people talk about interesting ideas, and I'm like, why don't I look at that? Because when it comes to Indian equities, I just buy a mutual fund. So I would say I'm predominantly 60% Indian equity. I want to go from probably where I am right now, 5-7% international, to probably closer to 20%. I'm not a big real estate fan, simply because I think that's an asset class that was outstanding for a lot of the 30 years I've been a practitioner. But I think it's a mature asset class. So I'd rather just have it as if I have a second home in Goa, then that's fine. But and then the rest, yeah. So I don't invest in gold beyond a point, but I would have some money in multi-asset. So that's a little bit about my style.
So you made an interesting point. You said the fund house is not important,
Yes.
right? When you select a fund. In India today, there are about 50 plus AMCs in India.
Yes.
So if fund house is not important, then what is when I select a mutual fund?
I believe that the most important thing, and I wish I listened to this advice I'm about to give your audience. The only thing that matters is time.
Okay.
Really, I mean, you could have bought the most average funds in terms of the category, or maybe a fund house that hasn't really done well. But if you gave it time, it tends to produce the returns that your aspirations and your goals want it to deliver. So for me, time and discipline about investing in the right way is the most important. It's like that Gisa Pita dialogue, right? Ki asset allocation is 90% of the path to wealth creation. The rest is, selection and so on and so forth. I think if you take that one step forward, I think investing for the right period of time and in the right asset class is 90% of the work. Then choosing which fund house, and I like I said, I think we are blessed in this industry where you have 50 intensely competitive people. If you look at the fund flows, they clearly reward performance.
Right.
So to some degree, there is a fair, decent median of performance. So I think spending too much intellectual energy on which fund house, which fund category, probably will lead you to the wrong conclusions.
So what are the parameters that I need to look at when I pick a mutual fund or a mutual fund category? Like you said, AMC doesn't matter beyond a certain point,
Yes.
but there are 50. I don't want to let's just blindly invest in one.
Yes.
Is there any kind of a filtration that a retail investor can do in terms of picking an
I
AMC?
think they can. And I think they can. The way I like to filter is to try and create some differentiation. So let's assume, since I started with the point that let's say 5 fund houses or 6 fund houses is the max, I don't want all 5 or 6 fund houses to be similar.
Okay.
So I'll probably pick, let's take 6 because that's easy. I will pick 2 of the largest fund houses because they've been there for a long period of time. They've got a long track record. They have scale and size. So therefore that possibly means access and so on and so forth. I will pick 2 from the middle pack, and I'll pick 2 of the smaller, younger people, but who probably come with backgrounds that would suggest that they over time will do well because they are run by people or they are run by groups that have produced good results in other businesses that they've run. So I have a mix. So I have 2 small fund houses, 2 medium-sized fund houses, 2
Small.
large fund houses, right? So
Yeah.
large, medium, small. So that's the first cut.
And how do you define large, medium, small?
I would say 2 from the top 10.
Okay.
2 from
In terms of size.
2 from the top 10 in terms of size, 2 from the next 10 in terms of size, and 2 from the rest.
Okay.
Right? So that's the first 6 in terms of how I pick fund houses. In terms of fund category, to be honest with you, between flexi cap, multi cap, small cap, and arguably mid cap. So these 4 should occupy 80% of my allocations within these 6 fund houses.
Okay.
So and probably invest.
What are the categories again?
Small cap and mid cap, because I believe that in India, over the next 5 or 10 years, there's going to be incredible success stories from smaller and medium-sized companies. And if you constantly think only large, you could miss that opportunity. So therefore, small and mid-cap as a standalone category is a good thing to do. I think flexi-cap and multi-cap take care of the ability for the fund manager to see opportunities across large companies, mid companies, across sectors like technology, consumers, and all of that. So
So
those
both you're saying flexi cap and multi cap.
do flexi cap and multi cap because multi cap forces the fund manager to have 50% in small and mid, right? So these are four that I would do. The fifth is actually not necessarily my equity allocation, but I genuinely believe that your largest allocation to any of these six fund houses should be in their multi-asset fund.
Okay.
Because to my mind, just think about it as Mahindra, right? Multi-asset should represent the best of everything I produce. You just said I have 15 funds, I am confused. If you had to ask me, tell me then one fund that I should buy because I'm only going to invest in one fund, I would say multi-asset because it represents my fixed income capability, it expresses my view on gold, it expresses my view on equity.
This is a new category that has been.
It's a new category that got created 2-3 years ago, and I think it's an incredible category. I believe in 10 years, it will probably be the largest category in India. So that's my simple math, right? So think about 6 fund houses, and I'm not suggesting that in each of these fund houses do each of these 4. So it's not 6 into 4, 24. I believe having 15 funds, 12 to 15 funds does the job. So you can pick and choose, right? I mean, pick 2 to 3 funds per fund house and you're home.
Okay.
Now the challenge, Sharan, I said, is the magic is time. Unfortunately, that's the most boring thing in life. I mean, just imagine if somebody listening to this conversation saying, this is great advice, I will do this. What will they do for the next 5 years of their life? Because we are telling them this is time, right? So you should do nothing. Now, nobody, we're human beings. So that's why I said 80%. 20% create excitement for yourself.
How do we create excitement?
Do international, do some thematic if you want to, right? Do stuff like that. That should not be the core is my point. But you need that because frankly, that I'll tell you plays a role of ensuring you give the rest time.
Don't touch the core.
You don't touch the core.
Play with your satellite.
Play with your satellite, and the satellite then allows you to indulge in themes that have suddenly become relevant.
So every fund house will have a certain investment philosophy, right?
Yes.
So can you educate me about the different investment philosophies that exist out there?
Yeah.
And what exactly do you follow right now with Mahindra Manulife?
Yeah. So I think actually I'm not sure how different philosophies are. I mean, frankly, beyond a point, the way I have understood equity is you buy a good business that has the ability to grow at a decent pace, run by good people, right?
At the right
and you
price.
buy it at a reasonable price and you hold it over time, you'll make money.
Right.
Now, I can put alphabets around all of this, and different people put alphabets, but essentially and I see this in the marketplace, right? People discuss factors, quality, momentum, etc. I'm like, dude, you're probably using this to explain why you haven't performed. Right? At the end of the day, India is a growth economy. Essentially, most investment philosophies across the board, therefore, are growth oriented. And irrespective of who you're having this conversation with, I think in their investment philosophy, like ours, our first part of our philosophy is G. We have a GCMV framework. So I'll give you the logic of that, right? So there's no point buying a business unless I have some innate belief that they have a reason to grow at a decent pace, right? So growth is the first important parameter we look at. The second parameter is cash flow. Because we've seen in the past that I'd like to see that business and its profits somewhere represented in cash. To me, it makes that story a lot more real than necessarily a narrative where cash flows don't represent. There are reasons sometimes where they don't represent because companies are investing and stuff like that. But for us, cash flow is important. Management is another important cog, right? The best way to explain this to you, Sharan, and I love sports, is you could have two teams. Sometimes captains can make a lot of difference to how that team plays, right? I mean, so I think having a management team that understands the growth opportunity but has the ability, the vision to execute, can distinguish a good growth business from another, right? And the fourth is price, very plain and simple. Now, because we use the word "we" value, that doesn't make us a value investor. At the core, I like to buy a business that I believe will grow. I need to see it represented in cash flow terms. I need to know and have faith in the people who are running that business. These are the three cornerstones, and I need to buy it at a reasonable value. This is what we do. I don't think anybody's investment philosophy is radically different. If you ask me, if everybody is the same, how come performances are different? Now,
Yeah.
there are many reasons. But if you ask me personally, in our context, we've added one sliver, which I think is about the DNA of the people that are in my investment team. We believe that it's important to use a prism which cuts across these four, which is called, what we've used the word, catalyst.
Catalyst.
Yeah, which is that there are always sometimes catalysts that change a thesis on something, sometimes for good, sometimes for bad. And sometimes being able to spot that catalyst early is a much better opportunity to generate alpha, even though the core is this GCM. And I'll give you one or two simple examples. I remember when lots of us were making this deck in terms of why should you buy Indian equity for the next 10 years. Everybody's first three slides look identical. India will be the third largest economy. We will grow at 7%. We will be a 7 trillion economy by 2030, etc., etc., etc. When you put all that and you do the math, you kind of come to the conclusion that, you know what, by 2027, we don't seem to be producing the power that will be needed to drive a $5 trillion economy. So we kind of said this is like a big catalyst in a sense, right? That power companies, which is the archetype of defensive bets. Now, I was brought up to understand that any company that can sell as much as the customer is there because there's so much demand is a growth business.
Yeah.
But here's a thesis I've realized, that whatever a power company produces will be bought because we need so much power, right? So we then said, okay, we've also signed up to climate change. Our Prime Minister is very passionate about it, but that's a 2050, 2070 goal, which then leads us to, and I obviously can't get into specifics, but we said there is a company that produces something that is very essential for thermal power plants. And there's so much rail infrastructure being built, which then means that this company has a tremendous growth trajectory for the next 5-7 years. And so for us, the catalyst was, yes, there's an economy, yes, 7 trillion, yes, third largest, all of that. But for us, the catalyst was the sheer lack of power generation that exists. If I had to give you one more prism, which is a little unique to us, and this comes more from Krishna, who's my chief investment officer. Krishna's view is that in a country like India, and this may sound extremely contradictory to everything I've been saying so far to your audience, which is think 5 years, think 5 years. Krishna's viewpoint is, as a fund manager, while I buy a company thinking about 5 years, I must have a 18-month thesis because the world is dynamic, the country is dynamic. And so we try to think about 5-year investments in 3 buckets of 18 months each.
Interesting.
We don't, because see, very often, I mean, Sharan, if I asked you a question, incredible journey with 1%, where will you be 5 years down the line? I mean, you will give me an answer, but even you don't know how incredible it will be 5 years down the line.
Yeah.
Now, you're the management.
Yeah.
I'm the investor. Now, if you're not 100% sure, how do I know what you will be in 5 years? I will have a thesis.
Right.
But I then need to have breaks in that journey to say, okay, I thought the 1% club would go from A to B. After 18 months, do I sense that that is playing out? If the answer is yes, I stay with it. So it's not as if we are not invested in companies for 5 years, but we are not giving them, this is not like a marriage.
So it's
You
like
can-
an 18-month checkpoint to see if the thesis
Yeah,
holds.
you can. I mean, I know this may sound corny. Think of it as this is an engagement.
Okay. In 18 months, then you'll decide whether to continue in the marriage or not.
And sometimes that decision doesn't need to be 0-1. मतलब ऐसा नहीं है कि बॉस I bought this company, it's 4% of my portfolio, and now after 18 months things aren't playing out, so 4 must become 0. Sometimes 4 can become 2. Sometimes 4 can become 6.
Got it.
Right. So these are not absolute calls.
So what is your opinion on the passive investing camp? People who say that, getting alpha is getting harder and harder. Most actively managed funds are not able to beat the benchmark. So why don't you just invest in a passive ETF, like how the Western countries are also doing? What is your view on that?
So I will give you let me clarify. It's a biased view in a sense, in one way, because I run only active funds, right?
Of
So
course.
by definition, I believe that I will outperform passive, and that's what we believe.
So maybe you can
Right.
help me with
But-
supporting macro.
No. But I'll tell you still a view. I think it has a role in a number of places.
Okay.
I think the ability to generate alpha in the large cap space sustainably relative to passive is getting tougher and tougher. So I clearly believe there's a case for thinking about a passive ETF, especially when it comes to large cap investing.
Yeah.
That's one perspective.
I mean, the data says that almost 90% are not beating.
But the second data which I have a problem with is, you see so many of these reports saying 70% of the active funds underperformed or
Yeah.
50%.
Yeah.
And I find it funny. I'll tell you why. They say 50% underperform, so you should go and do passive.
Yeah.
Now, how do you do passive? Yourself.
Yeah.
And my question is, if you're doing it yourself, then why are you comparing it with the regular plan? You should compare it with the direct plan. No, because nothing stops you from buying an active fund directly.
Correct.
So give you a perspective, Sharan. The average expense ratio in the direct plan of all my active funds is about 55 basis points.
So 0.55%.
Right? Mota moti. The average expense ratio of many of the passive funds is 40 basis points.
Okay.
And I can proudly say data shows this, that we have managed to deliver alpha in pretty much all of our active funds. So I'm saying the argument of passive over regular plans, yes. But if you can do it yourself in passive, then do it yourself in active as well.
No, I'm not comparing the regular.
But I'll just say this. If you're saying, I believe the opportunity in India is going to be delivered via a clutch of small companies, mid-sized companies, I think at least over the next 5-7 years, we'll still live in a regime where it will be a possibility to create alpha over the fees you ask as an active guy. But the moment you start saying no, for whatever reason, pretty much my portfolio consists of large and mid cap, I believe 50% of your portfolio will veer towards passive. And I don't think that's a bad thing at all. The moment you believe that multi-cap, small and mid-cap need to be part of your portfolio, I think active still rules over passive.
Okay.
The moment you start saying large and mid-cap is 90% of my life, then I think passive starts to be at least 50%, if not more.
So there is opportunity in the mid-cap and small-cap space still
There definitely is.
for actively managed.
There definitely is. And like I said, I know I've got a little too technical with this argument on direct, but I believe that opportunity is well served because, see, think about small cap, right? I mean, why would I want a status quo 250 companies in the portfolio, in a sense?
Yeah.
Not every small company is going to become big.
So basically investing in a regular, actively managed large-cap fund would be a crime today.
Crime would be a strong word because I have run a large cap fund where it has clearly not been a crime.
Right.
We're pretty proud of what we've been able to deliver. I'm just saying, when I wake up in the, you asked a question a long time, excellent. What is the day in your life look like?
Yeah.
When somebody says, Anthony, today we will spend trying to think about how we will outperform in large cap, it tends to be a tougher day. Because information is no longer that asymmetric. I think we have as an industry done really well in terms of how we've delivered in large cap to date. But if I had to put a crystal ball and say 5 years from now, do I have as much confidence in outperforming the benchmark on large cap as I have on small, mid, multi cap? My answer would be I probably have half the confidence, if not less than half. I'm just being very honest.
It's a very bold statement. I like that. Interesting. So, would you agree with me that investing in debt mutual funds today is not recommended for people who are in the 25-30% income bracket because it's no longer tax efficient?
So yes and no. That's why I brought up the topic early on multi-asset. So it is efficient.
Multi-asset.
No, but then it is efficient, right? So I agree. So in some sense, if you're in the 30% tax bracket, unless you have a very unique circumstance where interest rates are giving you a massive opportunity where you believe there'll be capital gain because rates will come down,
Yeah.
which is like, in 5 years it comes twice. So it's like, and more often than not, when it comes, you don't know. You realize only 6 months later ki yehi tha time, right? So I genuinely think that in fixed income, the best way to play it, if you're in the 30% tax bracket, is use multi-asset ka 20% of fixed income to represent your fixed income allocation.
So hybrid funds, basically.
Use hybrid funds.
So one question here. So if I take a multi-asset fund, there is also gold and debt. Now, if the equity component goes below 65%, the tax advantage is gone.
No. So interestingly, so in multi-asset, you need to be careful about, there are two types of multi-asset funds in a sense. There is a multi-asset fund that has kind of chosen equity taxation. So to your example, if a model suggests to those guys, and I would say 80% of the multi-asset funds have chosen the equity taxation philosophy. So let's assume my model says you should be ideally 50% in equity. There will typically be a 15-16% arbitrage position. So the equity taxation gets protected.
Yes.
So that's going to happen in a multi-asset, but there are...
That can happen in multi-asset also. They arbitrage
absolutely. So that's multi-asset is go anywhere, do anything in a sense.
Yeah.
Right? There is a 20% of multi-assets. We run one like that, which we have chosen hybrid taxation, which means that we have a commitment that we'll be at least 35% in equity. It allows me theoretically to go net 22% in equity if I feel the need. And the reason we chose that is the following. I genuinely believe multi-asset is your biggest expression of faith in me as a fund manager.
Yeah.
In a sense, right?
Yeah.
Therefore, I want you to give me the largest potential discretion. And the largest discretion we felt was if we chose hybrid tax, because if I wanted to be 50% in fixed income, if I wanted to be 25% in gold, silver or other commodities, if I wanted to be 30% in international equities, I should have the freedom to do it. If I needed that freedom...
you can do international also in multi-asset?
In our multi-asset, we've not done it to that, but we basically like I said, I believe our multi-asset fund is a fund where I could argue somebody should buy it for their grandchild and they could hold it 50 years from now.
Not think about it, because the fund manager will take all the calls.
Life will happen between equities, fixed income, gold, REITs, InvITs, international, domestic. My multi-asset can do all of that.
Yeah.
That's the way we created it. So there is a hybrid tax. Now somebody says, but I like equity tax. And I'm like, honestly, if you want to invest in a multi-asset fund with a 1-year time frame, you are causing harm to yourself. You should invest with a 2-year time frame. The answer is, yeah, of course, I'd like to do 2 years. Now, the beauty of hybrid tax is that in 2 years, the taxation is exactly the same as equity tax after 1 year.
12.5%.
It's 12.5% after 2 years. So that's the reason we chose that part.
Oh, wait, explain me. So if the equity allocation is below 65% in a multi-asset fund, you're saying that LTCG 12.5% kicks in after 2 years instead of 1 year.
If that fund has chosen the hybrid tax rule.
So you have to wait for 2 years to get the 12.5%.
Exactly.
Interesting.
You need to be careful about that. But like I said, we took the view when we were creating the fund that return comes first, tax on return comes second. If I create the fund thinking about the tax first, I'm possibly losing some flexibilities that are not...
Basically, you optimize for the alpha. If the alpha is more than 3-4%...
And the delta is 1 and 2 years. I mean, honestly, we made that call when the taxation was 3 years. The budget subsequently changed it to 2.
Yeah, makes sense. So you're saying pure debt funds for somebody who is already at a 25-30% tax slab might not make sense anymore.
I think multi-asset is a better route.
Got it. So I think, Anthony, now it's time for the rapid fire round. We've gone through the rabbit hole of various products, various asset allocation, fund selection strategy. Now I'm gonna ask you some questions for which I want quick answers. Okay, it's called the rapid fire.
Yeah, I do.
My first question is, in the current market scenario, would you recommend someone to do a lump sum investment?
Yes.
One habit that made you wealthy personally.
I'm not yet, that habit I didn't pick up, but time.
Time.
I should have given a lot more time to my investments.
What is the biggest risk right now for Indian equity investors?
Over diversifying into all kinds of sectoral and thematic.
One mutual fund category investors should avoid right now.
I would say maybe, the short-term, low-duration funds. Not sure how much value that will add.
NFOs, are they overrated or not?
I'll give you a rapid fire answer, but nuanced. NFOs from a new and upcoming fund house is fair play because they have to launch a fund. Otherwise, how do they build track record?
Yeah.
But NFOs from people like us who've been around for 10 years or more ask more questions in terms of what does it bring to the table.
Got it. Right now for diversification, would you pick gold or international equities?
International equity.
So one last question.
Yes.
How much cash should you be sitting on right now as a percentage in terms of waiting for a tactical bet?
Not more than 5-7%.
Okay, so it's now time to be 95% invested. That's what you're saying.
That's what I have personally done.
Got it. And then what are you waiting for, the 5% cash?
I told you, if I could listen to myself and do what I preached, then it would do, but I don't.
Got it.
I have always 30 years, I am a bank's CASA dream.
I think, Anthony, on that note, let's wrap up the conversation.
Thank you, Sharan.
Thank you so much for coming here and, explaining with so much patience. I'm sure your 30 years of experience could not be captured in this conversation. And but whatever discussion we had today, I personally enjoyed it. Any last, piece of advice that you want to leave the audience with before you go today?
So and it kind of captures, in a sense, my 30-year journey in this industry, right? It's our group's rise philosophy, which is that, and I think this is true for the mutual fund industry. So I'll make a pitch for the industry for my firm. In the Mahindra Group, rise philosophy says, only when you enable others to rise will you rise. Right. And so I think if we are able to all, and I think that's what you do for a living, that's what I do for a living. So that's the last message, that, there are lots of us hopefully looking to make the people who are listening to this rise, because in their rising, so will we.
Enable others to rise so that you can rise. Yeah. And that note, guys, thank you so much for watching till the end. Feel free to drop your own guest recommendations down in the comment section below, and me and my team will try our best to bring them on the next episode. On that note, I'll see you in the next one.
Before you go, guys, if this video gave you even one insight and made you feel differently about money, don't just keep it to yourself. Share it with your friends or family member who could use it too. And if it has sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make this conversation sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with one new thing every Wednesday and Saturday.